This is an analysis from Alpha Business Media. You know, for the last 3 years, the smartest financial move in Nepal was actually to do nothing at all. Just hold cash. It felt like a fortress against all the uncertainty. But today, we're going to talk about why that fortress is about to become a prison. Let's dive in.
This statement, it really gets right to the heart of a huge shift that's happening in our economy. The very idea of a safe asset is changing right under our feet. What used to be a shield for your wealth, well, it's now becoming a trap, one that's quietly eating away at your capital while a completely different kind of inflation is taking hold.
So here's how we're going to break this down today. First, we'll talk about why the age of cash is really over. Then we'll deconstruct this illusion of safety you get from bank deposits. We'll also dig into what makes Nepal's inflation so unique. From there, we'll outline a new kind of portfolio, one for a post-cash world. And finally, we'll look at the strategic outlook for the years ahead.
Okay, let's start by just admitting something that's true. For the last few years, holding cash wasn't just a good idea, it was really the only idea that made any sense.
I mean, think about it. With all the global craziness going on, keeping your capital, your dry powder, in a high-interest fixed deposit just felt like the smartest, most defensive move you could make. And you know what? It was. It wasn't just some random tactic. It was a completely sound, rational, and even profitable strategy.
And that whole strategy was backed up by the Nepal Rashtra Bank's aggressive fight against inflation, right? They jacked up interest rates, which made cash deposits look really, really attractive. But, and this is the absolute key, that whole era is coming to a close. The world's major central banks, they're all starting to pivot. The days of relentless rate hikes are over. Now we're looking at a period of stabilization, and pretty soon, the very real possibility of easing. And that global shift, well, it's going to inevitably force the NRB to do the same thing.
All right, so now let's get into how this big pivot is completely shattering the foundation of that whole cash hoarding strategy. This is where we really have to challenge what we think safety actually means for our money.
So what is it? What's the one fatal flaw that just completely unravels the whole idea of hiding out in cash? It's not about the stock market being unpredictable or anything like that. No, the real flaw is in how we've all been trained to measure the value of our money.
We all know about CPI, right? It's the inflation number you see on the news, the cost of food, of fuel, of rent. And for years, if your bank deposit was beating CPI, you felt like you were winning. But here's the thing, and it's a crucial distinction. Serious capital isn't being saved up to buy more groceries. It's meant to acquire productive assets.
And that is exactly where asset price inflation, or API, comes into play. See, this is the number that truly matters for capital. It's the one that tracks the rising costs of things that actually build wealth: land, commercial property, entire businesses. And this gap, this growing chasm between CPI and API, that's where your wealth is just silently vanishing.
And this right here, this is where the picture becomes incredibly clear. So your fixed deposit, it might be earning you a nice 8% after tax. It's comfortably beating that 7% consumer inflation. You feel good. You feel like you're making progress. But in that same time, the price of that piece of commercial land you've had your eye on has jumped by 20%. You're not winning. You're actually falling behind, and fast.
This really sums up the whole problem, doesn't it? Your cash gives you this illusion of growth because, the number in your bank account is going up. But its real power, its purchasing power to actually buy tangible, productive assets in the real economy, that's shrinking every single day. The safety of cash, it's a total mirage.
So, that leads to the next big question. Why is this asset inflation so relentless here in Nepal? To really get why cash is becoming obsolete, we have to look under the hood at the very unique engines that are driving our economy.
It really comes down to three powerful forces working together. First, our capital markets are incredibly limited. I mean, with very few places to invest your money beyond a pretty shallow stock market, where does all that surplus cash go? It has almost nowhere else to go but into real estate. Second, we have these chronic supply constraints, a lot of them created by bureaucracy, that just artificially choke off the supply of new land and property. And third, the biggest engine of them all, remittance.
Just think about this number for a second. Every single year, a flood of money that's equivalent to nearly a quarter of our entire GDP flows into the country. And a massive chunk of that money gets funneled directly into buying land. See, unlike other kinds of investment that can come and go, this is a steady, non-stop flow. It creates what you could call a permanent demand floor under the real estate market, which makes sure that prices almost never, ever go down.
Okay, so if sitting on cash is a losing game, then what's the winning one? We need a solution, right? And it's going to require a really disciplined pivot toward two specific kinds of hard assets that are just uniquely suited to the economic realities here in Nepal.
The new focus for capital has to be on two things: strategic commodities, so things tied to Nepal's actual physical growth, and a really unique category that we're calling distressed real estate. And these aren't just speculative bets, they're strategic positions. They're designed for both wealth preservation and growth in this very specific environment.
Now, that word distressed, it's kind of a misnomer here. See, in most of the world, a distressed asset means it's a bad asset. Its value has plummeted. In Nepal, it almost always means it's a good asset with a bad owner. The problem isn't the property's value. That rarely falls. The distress is in the owner's personal cash flow. They simply borrowed too much money, and now they can't pay their debt.
And here's the really actionable part. Where do you find these kinds of opportunities? Well, they're actually hiding in plain sight. They are listed every single day in the bank auction notices in the newspaper. These are not worthless properties. They are often prime assets that belong to owners who just got caught in a credit squeeze. And that means the strategic investor, the one with cash, becomes a liquidity provider and gets to acquire a really valuable asset at a fair price.
So finally, let's look down the road a bit. If we're going to navigate this new era, we have to understand the most likely scenarios for Nepal's economy and figure out how to position our capital for whatever comes next.
Really, there are two dominant probabilities. The base case, which has about a 65% chance of happening, is that we just sort of muddle through. In this scenario, interest rates fall slowly and that asset inflation just keeps climbing at its steady 10 to 15% per year. In that world, cash just gets slowly eroded. The second scenario is a big inflationary shock, maybe from some global event that causes a spike in prices. In that case, the flight from cash into real assets becomes a stampede.
But you see, in both of those scenarios, the conclusion is exactly the same. Holding cash is a losing strategy, and owning real assets is the ultimate safe haven. So the crucial point is this. The problem isn't just about individual investor choices, it's systemic. The whole cash is king mantra was born from a deep lack of other good options. To truly fix this, what we need is an urgent, even radical modernization of our capital markets, things like real estate investment trusts, regulated commodity exchanges. Because without creating new, productive places for capital to go, Nepali wealth will just stay trapped. The era of cash as king is over. The question now is, what's going to take its place?